Good morning and welcome to Financial Accounting. Today is officially day 8 of 30 for the semester. And before we get started, just a couple comments about what's upcoming. So we know that today we're going to be starting chapter 4, but chapter 4 is not on the exam this weekend. So we've already completed all of the material for the 3 chapters that are on the first exam. The exam is open now, as I had suggested on Tuesday. Please do not start the exam before you've finished the other assignments, because you're just setting yourself up for failure if you haven't prepared for the exam. The exam is time limited, and for those of you who gave me accommodation forms, you should see that your extended time is now available. If you think you gave me a letter and you don't see extended time when you go into Cengage, please let me know or resend me that letter. I only had a couple from this class. So there is a time limit. That's 3 hours for the exam. That's way more time than you need if you're prepared for the exam. So that time limit shouldn't make anyone anxious or concerned that you're going to run out of time. As I said on Tuesday, it's plenty of time if you're prepared. If you're trying to look up every answer and look up how to do every exercise, that's when you might have a time issue. But truly, I don't have people coming to me after the exam and saying, I ran out of time. I think you should be fine. Everyone should be fine with the time that you have. The annual report, the first installment of that, covering chapters 1, 2, and 3. We talked about that at the end of class on Tuesday. As you can see in the announcement, if you had submitted a company, it was approved. There's just not a way for me to comment privately, apparently, in Brightspace, and I didn't need to put my comments out there for everybody to see. But everyone's company, everyone who submitted a company, your company was approved, and so you are ready to use that for your project. And it turns out there were actually 3 students, not 2, like I said in the announcement, 3 students for whom I did not have a post. And so those 3 individuals have received a separate individual email from me saying, here's the company that you should use. So please make sure that's the company that you use. Apparently, as it turns out, I hear this morning that you can't actually see your own post on the discussion board, which seems to me quite bizarre. And I'm going to be looking into that. I can't fathom why you wouldn't be able to see your own post, but you can see everyone else's. So I don't know if it's a quirk in Brightspace or if it's something that I did. That discussion board actually carried over from Blackboard, so maybe it did something strange. I don't know. I wasn't aware of that until it was just mentioned before we started class. So I'm going to look into that and see if there is something I need to change, because what's that? Oh, really? So that just seems wrong. So I'll be looking into that and maybe I'll be able to fix it. However, for this class, the only discussion board we do for the whole semester is the one where you choose your company. So I'm not going to get too exercised about it. I posted this announcement yesterday morning. I may or may not have mentioned this idea in class on Tuesday, but I did schedule what Starfish calls a drop-in review session for this class. It's Friday morning from 9:30 to 10:30. It's on Zoom. I will not be here on campus. I do have another meeting at 10:30, so sometimes those run long, but it will not be able to run over tomorrow because I have to get to another Zoom meeting at 10:30. You are welcome to come for any part of that. Please do not skip another class to come to that. But if you have, 20 minutes between classes or whatever, you are welcome to come at 9:30 and leave at 9:45, or come at 10:15, or whatever works for your schedule. Also, I will plan to record it just like I record class. And though I will make that recording available after the review session. My expectation is that we will likely work on exercises from the practice set for the exam, but that's just what I think will probably happen. And I let that time be determined, how we use that time be determined by the people who attend. So if there's something specific you want to talk about, if you want me to just go over something that's not in that practice set, that's perfectly fine. And I will leave that up to you, but my using the practice set is just one suggestion. I think I told you on Tuesday, but I did have an email from someone not in this class, but in the online class, trying to figure out how do I find this practice set you're talking about. So I want to make sure it's clear. I can't show you because mine looks different. That in CNow, when you're in CNow, up the top of the assignments, there are 3 different options. All assignments, assignments I can take now, and assignments I can practice. The default is to assignments I can take now, but because the practice set is not graded, it doesn't show up on there. So you either need to go to assignments I can practice now or all assignments, and then it will show up. So it's called Exam 1 Practice Set. You'll see there's a practice set for each one of the exams. And again, as I explained on Tuesday, the exercises that I put in that practice set, I put in there for a reason, and that's because you can expect to see something very similar on the exam. So that it's not meant to have you doing work that's not going to be helpful. It is completely meant to assist you with preparing for the exam. It is not graded. I can see who works on it, but I don't necessarily look at that unless there's a question. And as I told you, probably week 1 of the semester, when I talked about those practice sets on day 1, if you come to me after the exam and say, I didn't do very well, what can I do to do better? The first thing I'm going to look at is, did you do the assignments that were required for the class? And the second thing I'm going to look at is, did you do the practice set that's optional? So if you want to just avoid that conversation, please just try the practice set. If you find it simple, if you say, yeah, I'm comfortable, I know this stuff, just gives you a bit more confidence. If you struggle with it, then you know what you need to work on before you take the exam. Questions about any of that? The same things I've already said before, but it's timely now because the exam is upon us. Okay. I will put this in the announcement after class also, but one last reminder, face-to-face. The exam is intended to be open book, open notes, but you need to open the book before you open the exam. So when you are in Cengage, you want to come to Study Tools and click on the ebook, and it will open in a separate tab. I assume most or all of you have done that before, but I also know there are different ways to navigate around in Cengage, so it may be that you do things maybe differently than the way I normally do them. So go to Study Tools, click on the ebook, have it open in a separate tab, then go into the assignments and start the exam. I have been told in a previous semester that if you try to open the exam and then open the book, it won't let you open the book. So you have to open the exam, you have to open the book before you open the exam. If you forget that and you start the exam and then try to open the book and it doesn't work, what do you think you should do? Email me immediately, because I can, if I'm anywhere near a computer, I can fix that for you. What I'm going to tell you probably is submit the exam, I'll delete it, and you can try again after you open the book. It's not helpful to come to class on Tuesday and say, yeah, I didn't get to use the book because I forgot to open it first. I can't help you at that point. You need to tell me immediately, and probably I will be able to help you right away. questions, comments, anything you want to talk about. I'm more concerned at this point about your comfort level with the first 3 chapters because that's what's on the exam. Unfortunately, the way this, our class is structured, we only have 30 class periods. I can't wait until you take that exam to start the next chapter. But what we're going to be talking about today is not on the exam. So it's not the most important thing right now. So is there anything you want to talk about? Okay. If not, we will start with chapter 4, again, not on the exam, but it will be on exam 2, which will be coming up in a few more weeks. We have an exam about every 3 weeks, on average every 3 weeks, because we have 15 weeks in the semester and 5 exams. So chapter 4, as you can see, the title of chapter 4 is the accounting cycle. We have a number of learning objectives. You'll notice the bottom 2 are for the appendices. We don't cover the appendices. We have more than enough work to do, keep us busy, to occupy your time and your mind. I don't think there's a single chapter where we cover what's in the appendices. So you can ignore that. There could possibly be a question on the pre-quiz because I don't control the questions you see on the pre-quiz. There could possibly be a question on the pre-quiz from one of the appendices. I don't think so, but there could be. The reason I'm okay with that, if it happens, is because you only have to get a 60% on that pre-quiz to get credit for it anyway. So there won't be anything in our exercises. There won't be anything in the homework problem. There won't be anything on the exam that comes from those appendices. So we have our hands full, again, looking at just the 7 learning objectives that we will be covering for this chapter. And really the purpose of this chapter is to think about how the accounting cycle works. So what happens during the course of a normal month? So most companies are preparing their financial statements internally once a month. They're closing their books, they're doing their raw, unaudited financial statements to see internally how are we doing this month. We already know from chapter 1 that all publicly traded companies are required to provide quarterly financial statements to the public, and they're required on an annual basis to have those financial statements audited, and then they present those in the form of the annual report. The annual report is what you're going to be looking at for that project all throughout the semester. So the company that you have chosen or been assigned in that case, the company that you have chosen, you're going to be accessing their annual report. They're publicly traded. They are required to make those publicly available. I've never once found a publicly traded company that I couldn't find their financial statements right on their website. The textbook also describes how you can find them on EDGAR, which is the SEC's website. It's not terribly user-friendly, in my opinion. So I would encourage you to just start with the company's website and use the annual report that you find there. The whole point of the project is that you are looking at what we're learning in class and saying, well, how does my company do the same thing? How do they present it? What do they say about it? In the annual report, what you will find is now that annual reports are available online as opposed to being actually printed and bound and mailed out to all the shareholders and made available to anyone who requested one, because that's pretty expensive. Financial statements or annual reports have gotten much, much longer than they were 20, 30, 40 years ago, when they might be 20 or 30 pages. Now, sometimes they run into the 100, 120 page range. You do not, please don't print out the whole thing. That's a waste of paper, a waste of your printing dollars. You won't need to read the whole thing. You're going to focus in on a couple main areas. You're going to, I would recommend that you go to the table of contents and find where it says the financial statements start. And it's usually toward the end of the document. So if it's 120 pages, the financial statements might start around page 80. They're going to look familiar to you because they, the format is exactly what we've been talking about for the last 3 weeks, starting in chapter 1 for the income statement, statement of stockholders' equity, the balance sheet, the cash flow statement. Even if they call them something different, you're going to notice those commonalities. The income statement is going to include revenues and expenses. The balance sheet is going to include categories for assets, liabilities, and equity. And then after those 4 financial statements, you will notice a heading that says notes to the financial statements. And then you'll have maybe even dozens of pages of additional detailed information about what's in those financial statements. And for some of what you need to do, you're going to go to those notes. Almost always the first note is about accounting rules. And so you'll be using that first note quite a bit to answer questions for the project. Very rarely will you need to go to anything beyond that first note that's about accounting principles that they follow. If you're looking at your project, if you're looking at your company's annual report, you're having trouble finding what I'm describing, I'm happy to help you with that. As I've told you many times already, in these first few weeks of the semester, I'm happy to help you with anything other than questions on the exam. You can always ask for help. And so there's no reason to submit something and write in your submission, I couldn't find this. You just need to ask and I'll help you if you can't, if you're making an honest effort to find it and you just can't. So again, what we're doing in this chapter is kind of getting the flow of how a normal company would work through their accounting cycle, which would typically be a month. So in objective 5, where it says illustrate, and objective 4, where it says describe the accounting cycle, they're talking about what happens throughout the month. What happens at the beginning of the month, the middle of the month, and the end of the month. So we'll be talking about that. So just to describe, and I know that's probably too small to see. If you do want to see it, it's in your textbook, so you can take a look at it. But you don't need to be able to read what's there at this point. I'm just going to describe how this works for any company. So throughout the accounting period, throughout the month, the majority of the time, all the company is doing in their accounting records is recording transactions. So we know from chapter 1, a transaction is something that affects the financial position of our company. When something happens, we record it. How do we record it? We write a journal entry. So you know now how to write a journal entry. And then the entry gets posted to the general ledger, and the ledger balances all get updated. Then we get to the end of the period, and we produce what's called the unadjusted trial balance. And we learned how to do that in chapter 2. Then we look at those accounts on the unadjusted trial balance and say, what's on here that shouldn't be, and what's not on here that should be, and we make those adjustments. So chapter 3 was all about the adjusting process, the chapter we just finished on Tuesday. All about the adjusting process. What kinds of adjustments do we need to make? How do we get them in there? How do we record them? And then, so those adjustments all happen in the last day of the month or the first day of the next month, and we just backdate it. We date it into the previous month, so it shows up there. Then we create the adjusted trial balance, and that's kind of our final working product. we have an adjusted trial balance. We look at it and we say, are these, are all the right accounts on here? Do they appear to have the right amounts in there? Is there anything that we missed? Did we record depreciation? Did we accrue the wages that people earned after the last payday? Did we adjust for supplies? All those things we talked about last class. And so now we have our adjusted trial balance, and we can use that to create our financial statements. I know it's pretty small, but here I can get my pointer up here. Give me a moment. So right here in this blue area, so if this is the trial balance and we have the unadjusted trial balance, then we have the adjustments, and then we have the adjusted trial balance. So this final set of columns here, debit and credit columns, these are the numbers, the values we're going to use to create our financial statements. We know from chapter 1, when we talked about the chart of accounts, that the accounts must be listed in a specific order. And that order lines up with that expanded accounting equation that I showed you. There's a snip of it in the chapter 1, or it's actually even above the chapter 1 folder in the reference materials. They have to be listed in the order: assets, liabilities, common stock, retained earnings, dividends, revenues, expenses, exactly the same order that they appear in that expanded accounting equation that I gave you. So if they appear in that order, then we know that the last set of accounts is going to be the revenues and the expenses. So this blue area, even if you can't see the numbers, you should be able to see right where my spotlight is right now, that these numbers right here are in the credit or the right-hand column. So those would be the revenues. And then all of these that appear in the left or the debit column, these are the expenses. So if you start from the bottom up, the debit balances are expenses. And when you get to credit balances, those are going to be the revenues. Above that, you can, again, even if you can't read what it says, you can see that we get into the dividends and equity accounts, and then we go into the liabilities, and then we go into the assets. So they're always going to appear in that order. As we use that adjusted trial balance to prepare our financial statements, the accounts in blue are the income statement accounts, and we use those first to prepare the income statement. 3-line heading, as always. Revenues minus expenses, we have our net income. That net income then comes over here to the statement of stockholders' equity and is combined with the accounts that are highlighted here in green. These are the equity accounts: common stock, retained earnings, and dividends, along with that net income from the income statement, helps us to prepare the statement of stockholders' equity. Then we have the ending balance for our equity accounts, which, as you already know, until we get to chapter 12, the only equity accounts we have, the only permanent equity accounts we have, are common stock and retained earnings. We have those ending balances. They're going to flow up here to the balance sheet. And then the rest of the accounts, the other permanent accounts, assets and liabilities here, come over to the balance sheet as well. And so all of that, the adjusting the accounts happens at the end of the month, the very beginning of the next month. The preparing the financial statements happens at the beginning of the next month, once the adjustments are done. The next thing we do, once all the adjustments are done and we prepare our financial statements, is we're going to close the temporary accounts, and we will see in this chapter how to do that. So we know that temporary accounts are dividends, revenues, and expenses. All of those accounts at the end of the trial balance, at the end of our chart of accounts. And those are temporary or nominal accounts. They don't carry their balance forward. So at the end of the month, after we've adjusted the accounts, after we've prepared our financial statements, then we close those temporary accounts. By closing them, it means we zero them out. Whatever's in there, we take it out. So they're back to zero. We start from scratch for the next month to record and accumulate our revenues, expenses, and dividends. That is, in a nutshell, everything that we're doing in this chapter. Any questions about what I just described? There really was not a lot of new information there. This should be reinforcing what we've already talked about. There are studies in psychology that show that once you hear something 7 times, you remember it. So I know I'm repeating myself. And if you heard me and remembered it the first time, that's fantastic. But there are probably other people in the room who are like, wait, what did she say again? So my goal, the reason I asked you to skim the chapter, to do the pre-quiz, to come to class and listen to what we're talking about, the reason I repeat myself in class is so that eventually you've seen it, heard it 7 times, and maybe then it sticks. Questions so far? If not, we're going to go to our first exercise for today. And the first exercise is, again, a little bit of review from what we have already done. I'm going to do a couple of these with you. I think we have time. We'll go through the whole thing together. Think about the time. So, giving you just a moment in case you're not already in Cengage to get to chapter 4 exercises and the very first exercise. So what we're doing in this exercise is putting into practice what I just reviewed for you on that last slide in the PowerPoint. The question that we're asked here really is, where do these accounts belong? Which financial statement? Now we're only looking at 3: income statement, statement of stockholders' equity, and balance sheet. We know there's a 4th financial statement, and that is the statement of cash flows. If you were looking at the learning objective page, you may have noticed that one of the appendices for this chapter was about the statement of cash flows. But we really are not doing anything with that until we get to chapter 13 at the end of the semester. The reason it's not included here is because many accounts that appear on the first 3 financial statements also appear on the cash flow statement. The reason we don't do anything with it and don't really talk about it until the end of the semester is because it kind of pulls everything together from the first 3 financial statements. So if you don't understand those, if you don't know what's on those, you would not really be able to do the cash flow statement. So we're only choosing from those 3 financial statements, the first 3. So let's start with accounts payable. Now, I told you when we talked about this in chapter 2 that it's important to ask yourself the question, when you see an account title, the first question you should ask is, what kind of account is this? Because you can't really answer this question about where does it belong until you know what type of account it is. So with accounts payable, what type of account is that? We know there are 5 options. 5 options. Assets, liabilities, permanent equity. I guess that's 6 options. Dividends, revenue, and expenses. So which type is that? The liability. How do you know that? Because it's got that word payable in it. Yep. So anytime you see that word payable, it means we owe someone, we will pay them later. So if it's a liability, it belongs where? Balance sheet. Whoops. Yeah, I clicked the wrong one. Sorry. Balance sheet. Talking with someone before class, I was thinking I should remind everyone about this. So in Brightspace, in the reference materials folder, I can get there. You look at the chapter 1 folder, you'll notice there's a page here that says important information for chapter 1. I'm just going to do this. So let me get back there. Sorry. Wanted it to look like it will for you. So in the chapter 1 folder, there's this page that says important information for chapter 1. And if you click on that, you'll notice it's kind of a summary of the things that we've been reviewing today including the fundamental accounting equation, and then a summary of the 4 financial statements and which types of accounts appear on each one. So you may want to kind of bookmark this. There's the little bookmark right there in Brightspace, so you can bookmark that to be able to get back to it more quickly. Just remember that it's here if you need to refresh your memory about any of those. So liability, accounts payable belongs on the balance sheet. How about accounts receivable? What type of account is it? It's an asset. So, and we know that because it says receivable. That means someone owes us and they will pay us later. Then we'll have the cash and we can do with it what we want or what we need to do. In the upcoming chapter 8, I think, is a chapter called receivables, and we'll spend more time talking about that, but just a little bit of information. So a company that has receivables can actually bundle those receivables and do what's called factoring them, which means basically they sell their receivables. I occasionally hear ads on the radio for companies that buy receivables, and that's their business. They buy receivables and then they try to collect on them. Why would you do that? Well, if you're selling the receivables, you do it because you need the cash, right? And if you're buying the receivables, you do it because you get a discount on them. So let's say the company's owed $100. Maybe you give them $80. They give you the $100 receivable. You go collect from the client and you get the $100. You just made a $20 profit minus your expenses in collecting that. So receivables are an asset because we can use them to benefit our company, and because they're an asset, they belong on the balance sheet. How about cash? What type of account? Asset, so it belongs on the balance sheet. How about dividends? Dividends is kind of its own separate little account. We don't really have anything else that's like it. Dividends reduce our retained earnings. Dividends represent amounts that we pay to our stockholders as kind of a thank you or a reward, a return on their investment. And so dividends are a temporary account, but like other temporary accounts, revenues and expenses that are on the income statement, dividends don't show up on the income statement. They also don't show up on the balance sheet because they're a temporary account. The only place they do appear is on the statement of stockholders' equity. And I should clarify that they also appear on the cash flow statement. But of these 3, they only appear on the statement of stockholders' equity. They reduce retained earnings. Fees earned is our revenue account, so it would appear where? Income statement. Supplies, now it doesn't say supplies expense, which would be an expense account. It just says supplies. So that represents the value of the supplies we still have on hand. That is what kind of account? An asset, so it would appear on the balance sheet. Thank you. Unearned rent. We spent some time last class again talking about unearned revenues. That's what unearned rent would be. So it means that we are a landlord, we are a property owner, and our tenants, our lessees have already paid us, but they haven't yet occupied the space for the time that they have already paid us. And so it represents a liability for us. And so it appears on the balance sheet. Unearned, it's an unearned revenue account. We still owe them the use of our space, our property, for some period of time. The next 2 should be pretty straightforward. They both include the word expense. So we know that they are expenses, and they will appear on which financial statement? Income statement. Thank you. And our last one, just like number 1, it has that word payable. So we know it's a liability and it appears on the balance sheet. Okay, so good, valuable review for us to think about the flow of those financial smaller apparently, about the flow of those accounts into our financial statements. Everybody good? Okay. Let's move on then to number 2. So what you see at the top of the screen, or taking up most of the screen right now, is similar to what I was showing you in that last slide on the PowerPoint. This is the end of period spreadsheet. We are not going to be creating our own end of period spreadsheets. That was appendix number 1, I believe, and we're not covering that. But you should at least be familiar with the layout, and I did just describe it to you in the PowerPoint. So we have all the account titles listed in the proper order over here on the left-hand edge, starting with our assets, cash, accounts receivable, supplies, land, building, accumulated depreciation goes with the building. So those are all of our assets. Then we have our liabilities, accounts payable, salaries payable. Then we have our common stock, retained earnings, and dividends, those equity accounts. Then we have our revenue, followed by 4 expense accounts. These columns appear in sets of 2 because they're debit credit columns that go together. We have our unadjusted trial balance, then we have the adjustments, and finally the adjusted trial balance. We are asked to use that spreadsheet to prepare our financial statements. So of those sets of columns, which set of columns are we going to use to prepare the financial statements at the end of the period? Do we want to use the ones that haven't been adjusted yet? No. Do we want to use the ones that only have the adjustments? No. So we definitely are focusing on the final 2 columns to the right. That is the adjusted trial balance. So those are the values that we're going to be using. We always start with the income statement. And as I described earlier, it's easy-ish to know which accounts we use because we can start from the bottom and just work our way up. We know that the last things listed are the expenses. And then when we get to a credit balance, that's going to be the revenue. So we could even draw a line if we wanted to separate right there. Whoops. Tail at the end to separate the income statement accounts from everything that comes before it. From there, then you should be able to, and I'm just going to let you do this on your own. You should be able to complete the income statement. You'll notice the heading, always a 3-line heading, name of the company, name of the financial statement, and then the range of dates that it covers for an income statement. So it's important that we know this is for the year, not the week, the month, the quarter, the day, or whatever. Now on a real income statement, I'm going to suggest that there may not be a wrong order to include your expense accounts. Just like if there was more than one revenue account, there may not be a wrong order to put them. However, our software is looking for them in a specific order. And the order it usually wants them is in largest dollars to smallest dollars. Okay, largest to smallest dollars. The exception to that is if there's a miscellaneous account, as we have here, miscellaneous always goes at the end. That's always going to be a relatively small number. And it combines a whole bunch, potentially a whole bunch of different kinds of expenses. And that's why it doesn't go in numerical order. So it turns out that the order that they have them listed in the trial balance is the same order they're going to go into our income statement. You'll also notice that the software gives us a little bit of an assist because when we look at that drop-down menu, it doesn't show all of the account titles. It only shows a small selection of them, and it only shows one expense on each one of these lines. And so As long as you know that expenses go on the income statement under expenses, you're going to get them in the correct order. However, if you were really working in accounting and looking at this, why my speaker's making noise? If we were really doing this, each one of those drop downs could be every single account title in the chart of accounts. Actually, we wouldn't be hand typing any of these. The accounting software would allow us to simply say, produce an income statement for the year ended March 31st, or for this date range, April 1st, 2018 to March 31st, 2019. And it would do it for us. So we wouldn't be going through all of these steps. I need the total of the expenses. Does anyone already have a total for those? $1,010,000, like that? All right, thank you. Saves me a little bit of work on my calculator. And then to find our net income or net loss. So it's going to be a net income if our revenues exceed the expenses, and a net loss if our expenses were higher than the revenues. So now, once we have the income statement, we move on to the statement of stockholders' equity. It's important to note in the software, sometimes, like now, it does tell us to use a minus sign. And so when it tells us to use a minus sign in certain circumstances, it will mark it wrong if you don't use a minus sign. In this case, it's telling us if we're going to subtract, use a minus. Sometimes it doesn't say, and if it doesn't say that, it will accept the value either way, whether you use the minus sign or not. As you know, the statement of stockholders' equity includes the beginning balances at the beginning, the ending balances at the end, and in the middle, we show the impact of those transactions or events that can affect our stockholders' equity. So it could be that we issue some common stock. And up here, in case you didn't notice, I hadn't pointed it out. It does tell us up here at the top that during the year, they did issue 15,000 more in common stock. They sold more of their own stock. Why would they do that? To generate cash. They needed some financial capital for some purpose. They sold some new stock. We'll talk more about that in chapter 12. We then also hopefully made some money that will increase our retained earnings, and we may have paid out some dividends. So we start with our beginning balances. We want to make sure we're using the ones from the adjusted column, even though there were no adjustments here. So these numbers are the same all the way across. We started out, we started the year. Sorry, I shouldn't have said it like that. We ended the year with 100,000 in common stock. But it told us, so that's the ending balance. But it told us that we issued 15,000 more in common stock during the year. So how much must we have had at the beginning of the year? Thank you, 85,000. Now you'll notice I'm not putting anything in that column for net income or dividends because it tells us here if an amount does not require an entry, leave it blank. Putting zeros in there would just kind of make it confusing to read. What do we have for retained earnings? Retained earnings, we have $1,860,000. But remember, all of these accounts down here, starting with the revenues through the expenses, all of that represents retained earnings income that we haven't yet added to the retained earnings. That's what we're going to do now. So the balance in retained earnings is actually the beginning balance for retained earnings, because nothing has been closed yet. We haven't closed those temporary accounts. So I'm pointing this out because for the common stock, we had the ending balance. We had to back into the beginning balance. But the retained earnings works in the opposite direction. So on the income statement, we just calculated the net income, so we can add that. And then in our trial balance here for dividends, you can see $30,000 in dividends were also paid out. And remember, because that reduces our retained earnings, we need to show that as a negative. And then it's just a matter of adding across and adding down. So go ahead and finish that up on your own. And God bless you. And you can check yourself by making sure that that bottom right cell is the total adding across and adding down. Of course, we can also check by clicking the check my work button. Somebody pointed out when I was talking with him yesterday, there's no check my work button on the exams. You will be able to, after the exam closes, you will be able to check to review how you did. As I told you on Tuesday, you'll see your grade immediately when you submit it. But later, next week, you'll be able to actually go back in and look at each question that you missed and see what the correct answer was. Absolutely, you should ask if you can't figure out why your answer is wrong. I'll be happy to help you with that. We generally do not talk about them in class just because you don't know, and I would encourage you, I would ask you, please not to talk about the exam with your friends or classmates, because you don't know whether that person has already taken the exam or not. Unfortunately, regardless of what they tell you, sometimes and I've had this happen before, that someone might tell you they've taken the exam when they actually haven't. Okay. I want to hang on to the balance sheet just for a moment. I'm going to go back to our PowerPoint before we do the balance sheet. Give me one. Okay. So we'll come back to that balance sheet in just a moment. So the income statement and statement of stockholders' equity that we just did in that second exercise look exactly like what we've done up to this point. But if you looked ahead or started working ahead, you may have noticed that the balance sheet looks a little bit different. The basic format is still the same. We have our assets on one side or on the top. Then we have our liabilities and equity on the other side or on the bottom. And it still will be true. It will always be true that the total of our assets is equal to the total of our liabilities plus equity. But on this balance sheet, we don't just list all of our assets and then total them. We're actually going to divide them into some subcategories or subsections. We may do the same thing for liabilities. And we really already do that for the equity section, because we've been talking about it as already two separate categories: the common stock or contributed capital, and then the retained earnings. So what we're doing new in this chapter is classifying the balance sheet. The totals won't change. If we had $100 in assets before we classify balance sheet, we still have the same $100. But what we're going to do is divide those assets into categories that will help people using our financial statements. Remember, from chapter 1, the whole reason we do this is to help people make decisions about our company. And so if we recognize that there's a way that we can present the information in a little bit more useful, a little bit more meaningful way by classifying the balance sheet, then that's what we're going to do. So for our purposes for this class, we generally have just a couple categories because we aren't looking at every single possible type of asset that's out there. There are definitely other categories that you may see when you look at the company you've chosen for your report for this semester. But we're keeping it a little simple, and we have two categories: current assets and then property, plant, and equipment, also known as PP&E, or fixed assets or plant assets or long-term assets. God bless you. So the current assets are things that are practically cash, things that are going to be used up, sold, turned into cash within 1 year or the normal operating cycle, whichever is longer. So our current assets are the things that we have available pretty soon, practically immediately, to use to run our business. So it includes things like cash, accounts receivable, supplies, inventory, things that we expect to use up or sell or turn into cash within 1 year. Notes receivable is a little bit different. So accounts receivable, we've already mentioned, represents the amounts that we billed our customers, but they haven't paid us yet. They agreed to pay later. We agreed to let them pay later. Notes receivable is more like a loan to a customer or a client. The biggest difference between notes and accounts receivable is that notes receivable include interest and accounts receivable do not. So as I mentioned earlier in class, we have a whole chapter coming up in several weeks called receivables, and we'll come back to that, learn more about notes receivable and interest at that time. The other category that we have listed here is the long-term assets. Most of these assets are going to be subject to depreciation. So we spent a little bit of time on Tuesday talking about depreciation. Almost all of the assets that appear in this category, property, plant, and equipment, are depreciable. The exception is land. So land is not subject to depreciation, even though it is a long-term asset or part of PP&E. So with that description, let's go back to our balance sheet, and you will notice what I have just described: a section for current assets, and then we have a total. A section for property, plant, and equipment, then we have a total. In our liabilities, if we have enough liabilities that it makes sense to separate them, we can separate our liabilities into current and non-current or long-term liabilities. That distinction for liabilities is based on two things: when is it due, and how are we going to pay for it? So in order to be a current liability, it needs to be due within 1 year, and we expect to use current assets to pay for it. Anything that doesn't meet that definition is considered non-current or long-term. In this case, you can see on our template that we don't have any long-term liabilities. We just have two listed as current liabilities. So it is still true on the balance sheet that we want to list things in decreasing order of liquidity. So in our current assets, we start with the things that are closest to cash. Cash is always going to be listed first. The other assets that we have, if you look back up here, accounts receivable, supplies, land, building, and accumulated depreciation on the building. So I'm just going to go ahead and put those headings in here. And then we can start pulling in the dollar amounts from that spreadsheet up at the top. I'm not going to keep scrolling up and down at the risk of making people seasick because I have a printed copy of that. You can either scroll up and down yourself to put your numbers in, or you can look at what I'm putting in. And so what is new is that we have a subtotal for the current assets. I should point out the formatting to you, as I like to do. We have a 3-line heading at the top. The balance sheet is the one of the 4 financial statements. It's a snapshot that just shows us where we are at a point in time. And so it is not correct to have it say for the year, for the month, for the quarter, or anything else. The 3rd line is just a single date. You'll notice at the top of each column, there is a $sign, and then we don't repeat the $sign until we're taking a total. So we see a $sign here, we see a $sign here, we see a $sign here because it comes after this subtotal bar. $sign here, but not underneath. Let's go to our property, plant, and equipment. Now, we did see on Tuesday how to calculate and record the book value of an item. We had equipment in that question about depreciation. And so we're going to be doing that here when we get to the building. So our building, sorry, the land first. The land is on our books at $1.4 million. That means that's how much we paid for that land. Land is not subject to depreciation, as I said a moment ago. And so that 1.4 million represents the amount we paid for it. And we will leave it on our books at that amount until or unless the value becomes somehow compromised. So if there's a Superfund site, which means there's some kind of contamination next door to us, it might reduce the value of our property. It might become impaired, and then we would have to write that value down. But in general, we record land at what we paid for it, and we just leave it alone the whole time we own it. All other long-term assets, property, plant, and equipment, are subject to depreciation. So when we look at our adjusted trial balance, we see the building account has a value of $850,000. That's how much we paid for that building. But the whole time we've been using it, we've been recording depreciation. And so you can see the next line has accumulated depreciation with a credit balance. Where is it? There it is. Of $72,000. That means over the period that we've been using that building, we have recorded a total of $72,000 worth of depreciation. That's how much we have written off as expense. That does not mean the building's worth $72,000 less than what we paid for it. It could be worth exactly what we paid for it. It could be worth more. It could be worth less. There's no attempt to make the value on our balance sheet match with the fair market value. That is, what could we get if we sold this building? So the book value of the building is the original cost of $850,000 minus the accumulated depreciation of $72,000. The book value then is $778,000. We add that to the value of the land to get our total property, plant, and equipment, or PP&E. And then we add to that the current assets to get our total assets. So this is called a classified balance sheet. Includes all the same information as the simple balance sheet that we learned in chapter 1. We've just broken up the assets into a couple different categories. And think on Tuesday of next week, I don't think we'll get to it today. We will see how we might be able to use this information when it's presented like this. It might make analyzing the information or making decisions from the information a little easier. Now we can tell from the format that the liabilities we have are current liabilities, accounts payable and salaries payable. We certainly might have other long-term liabilities such as pension liabilities, or maybe we have some bonds outstanding or mortgage on some of our property. But the two liabilities we have here, accounts payable, salaries payable, are both current. And then we can total our liabilities. If there were long-term liabilities, we would just have a separate category for long-term, or non-current liabilities, have a separate total for those. Add them to the total of our current liabilities to get the total liabilities. Let me make one more comment about the asset piece. So I told you, for the most part in class, we're only going to be using those two categories, current assets and PP&E. Many companies, though, have other categories in their assets. They might have a category called investments. They might have a category called intangible assets. They might just have a category called miscellaneous or other assets, things that don't easily fit into those two categories. But for our purposes, we're typically going to have just those two. They're not the only two you are likely to see on the company that you chose for your project. You're likely to see more than that. Now we know until chapter 12, our stockholders' equity section is going to have exactly those two accounts, common stock and retained earnings. So where do we get the balances for those? Remember, on the statement of stockholders' equity that we just did, we calculated the ending balances. These are the ending balances that go on your balance sheet. 100,000 in the common stock and $24.95 in retained earnings. For a total of $25.95. And then we add that to our liabilities. And what we better see is that our total assets is equal to our total liabilities plus equity. Those two numbers have to be the same. They're always going to be the same. This number and this number have to be the same. It was from the statement of stockholders' equity. So if you just scroll up a little bit, the bottom line of the statement of stockholders' equity has all our ending balances. And so if you finish your balance sheet and you find out those two numbers that I just boxed in red, the total assets and the total liabilities plus equity, are not the same, you know you've done something wrong. If that happens on your exam when you don't have the check my work button, what are you going to do? Well, the very first thing I would do if I were you is make sure you pull the ending balances from the statement of stockholders' equity for the equity piece. Because that's definitely the most common mistake. If that doesn't work, check your math. Did you subtract the accumulated depreciation to find the book value? Did you add the correct numbers to get the total? So did you add the subtotals for current assets and PP&E to get the total assets? It's 100,000. Oh, retained earnings is 24.95. 000. 2,495,000. And that comes from the last line of the statement of stockholders' equity. So right here. And as I said, that's the very first thing I would check. If you finish your balance sheet and you find out it doesn't balance, that's the most common thing. It's really an easy mistake to make if you think about it. Because where did we get the balances for the balance sheet? Well, we just started here at the top and started pulling all of these numbers in, and we just keep pulling them in one at a time. Oh, until you get to retained earnings. And retained earnings comes from a whole different place. So it's a very simple mistake to make. That's why it's very common, because you do not use the balance from the adjusted trial balance column here. Why not? Because it doesn't include the net income, and we haven't yet subtracted the dividends. So we have to look at the statement of stockholders' equity right here to find out the actual ending balance, including the net income and minus any dividends. Any other questions before we keep moving? Okay. Let's go on to our next exercise then. The next exercise, maybe I can make this a little bigger now. So my control key stuck down. So the next exercise focuses on the statement of stockholders' equity. And it shows us 3 T accounts. So before we look at the statement of stockholders' equity that we're asked to construct here at the bottom, I just want to look at these T accounts and think about what's happening, talk about what happened during the year for this company. Climate Control Systems Company offers its services to residents in the Spokane area. Selected accounts from the ledger of Climate Control Systems for the fiscal year ended December 31st, 2022 are as follows. So we can see in the common stock account, we had an opening balance at the beginning of January of $75,000. We already had sold in the previous period $75,000 worth of our stock. In February, we added to that. We added another 25,000. So what must have happened there? We sold some stock, exactly. We sold some stock. And so if we go down here to the common stock account, and I'm just going to put in the headings, same headings we had for the previous exercise. And I put net income, but we'll talk about whether it was a net income or net loss. I just wanted to put something in there. So now we can complete that common stock column. We started the year with 75,000 in that account. We sold 25,000 more in stock, and so the ending balance would be 100,000. In the retained earnings account then, we had an opening balance, we can see right here, of 4,150,800. So we can put that in. Oops. 4,150. Okay. And we can add across, why not? We can go ahead and add across the common stock row as well, because that doesn't affect our retained earnings. But let's see what else happened in our retained earnings account. Let me see. We credited 700 here and we debited 160. Well, we can see where that 160 came from. It's the dividends. Each quarter, so a quarter is 3 months. Each quarter, so we can see the dates there, end of March, end of June, end of September, end of December. Each quarter we paid out, we recorded cost of $40,000 worth of dividends. And at the end of the year, when we closed our books, we removed that 160 of dividends from retained earnings. So the credit is here to close that dividends account. Again, in this chapter, we'll be seeing exactly how we do those entries. So we debited retained earnings, we credited dividends, we reduced our retained earnings. And so I'm going to put that here. In the dividends row, under retained earnings, we reduced our retained earnings by $160,000. We paid $40,000 in dividends, a total of 4 times throughout the year. Now in chapter 12, we'll talk more about dividend policy and how did this company decide to pay $40,000 each quarter? Why didn't they just pay $160 a year? They could have done that. Who decides that? Who decides how much? Who decides when? We'll talk about that in chapter 12. But the other thing that we know can affect retained earnings is recording income or loss. And I said I wasn't sure when I put in the headings whether it was an income or a loss, but we can see right here what I have highlighted, a credit to retained earnings of $700,000. So let's think about it. Retained earnings is an equity account. Equity accounts have a normal credit balance. So if we credited that account, we actually increased our retained earnings, right? So did we make money or did we lose money if we increased our retained earnings? We made money. So we're going to show that as a net income and a positive or an addition to our retained earnings. We are told again, we need to use that minus sign, the negative. And then add a cross and down. Check yourself. Or just use the check my work button here. On the exam, I would recommend that you add a cross and down to check. And so at the end of our accounting period, since this chapter is about the accounting cycle, at the end of our accounting period, we're going to be preparing these financial statements, taking into account the changes to our equity accounts because of our earnings, because of any stock we may have issued, because of any dividends we may have paid. Now, in any given year or any given accounting period, there's no guarantee that a company issued more stock or paid dividends. They may not. Some companies don't ever pay dividends. Any questions about this exercise? All right. So exercise 4 is a balance sheet. Again, it is a classified balance sheet. Since we have already done one of these together today, I am going to ask you to complete this on your own, but we can do it right now. I'm going to pause the recording. And so if you're watching on the recording, please pause your recording until you finish this exercise. And if you are here in class, I'm going to ask you to try it on your own. I'm going to put mine up on the screen. You'll notice that the cash balance is missing. So you're going to have to be a little creative in how we find that cash balance. I'll just remind you that the total assets must be equal to the total liabilities and equity. So if you can find the total liabilities and equity, you'll know what the total assets must be. If you know the total property, plant, and equipment, you can subtract that from the total assets to get the total current assets. And then you can find the missing balance for the cash account. So try that on your own and then restart the video. Okay, so for this exercise, again, the accounts were not given in the proper order. So we had to look at each account and think about where did it go. The template gives us a little bit of a hint because, for example, under the current assets, maybe we weren't sure. We knew cash would come first, but for the other four, we weren't sure which order they should appear. But on the drop-down list of accounts, this is the only way that would be possible, getting the correct accounts under current assets. So I started out, he didn't know the balance in the cash account. And so we'll come back to that. So in our property, plant, and equipment, we have our land, we have our equipment with its accumulated depreciation, so we can subtract that to find the book value and our total PP&E. Under liabilities, we have 3 current liabilities, no long-term liabilities. List those and total them. As always, $ sign at the top of the column, but not for the subsequent numbers. Under equity, we have our 2 accounts that we will have exclusively until chapter 12. Common stock, retained earnings, we can add those to get our total equity. Add that to the total liabilities to get our total liabilities plus equity. And then we know that that number must be the total asset number, 750,000. Subtract from that the PP&E of 505,000, and we know that our total current assets must be 245,000. At the time, I knew these 4 items and didn't know the cash, so I simply subtracted those 4 items from the total current assets and found that the cash balance must be 93,000. Any questions about that exercise? Okay. Well, if you've looked ahead, you will notice that the next exercise looks very similar. We have a balance sheet and we have to create a new balance sheet. The problem is we're told there are some errors on this balance sheet. And so I just want to talk about what those errors might be. We have about 7 minutes left in our class time. After we talk about what kind of errors you're looking for, I'm going to pause the recording, let you work on this balance sheet on your own. This will be the end of class for today. And so if you're comfortable with this, once we pause the recording, you are good to go. And when we come back next class, we'll talk briefly, if needed, about the exam, the project, and then we'll finish up chapter 4 on Tuesday. So here's the kinds of things that you're looking for. It says that these are current assets. But as we look at those account titles, I see a couple that are not current assets. What do you see there that shouldn't be there under current assets? Accounts payable. Why doesn't that belong there? Because it's a liability, so it needs to go down to the liability section. What's another one that you see there that maybe shouldn't be a current asset? Land, because we aren't going to use up the land within 1 year. So that's going to be reclassified. Under PP&E, we have building and equipment, but I notice we don't have depreciation on either one of those. Those are listed down here, so we're going to need to move those up and calculate the book value for the building and equipment. We have accounts receivable as a liability, but is that a liability? No, it's a current asset. How about net income? Does that belong on the balance sheet at all? No, so that's just going to need to be removed. We have wages payable under stockholders' equity. What kind of account is that? Got that word payable. What kind of account is wages payable? It's a liability. And it's a current liability. Think about it. If your boss said, yeah, I owe you $6,500, but I'm going to pay you a couple years from now. Is that going to fly? Probably not. It's a current liability. People expect to be paid in a timely fashion for the work they performed. And then we have common stock and retained earnings. So you can assume that the dollar amounts they have for each one of these accounts is correct, but the accounts are just in the wrong place. So go ahead. I'm going to pause the recording. I'm going to fill out mine on the screen here, and I'll restart the recording when I'm done. For those of you who are here in the classroom, you can finish up and we're done for the day. Okay, so just to finish up this final exercise for today, I didn't point out, but you'll notice the heading, the date lines on the incorrect balance sheet says for the year ended, but they have corrected that for us so that it says just the single date. I have sorted the accounts into the proper area, so we have our current assets totaling 83,000. Our property, plant, and equipment, we have correctly calculated the book value by subtracting the depreciation from the historical or original cost for each of the building and the equipment. So we have a total PP&E of 542, making our total assets 625. That's the total of the PP&E and the current assets. As we look at the bottom part of the balance sheet, then we have our two current liabilities, accounts and wages payable, totaling 37,800. We have our two common stockholders' equity accounts, common stock and retained earnings, totaling 587,200. Add that to the total liabilities, and we can see that our total liabilities plus equity are 625, and that matches our total assets as it must. Thank you for being here. Good luck on the exam. Please let me know if you run into any technical issues right away. And I will see you all on Tuesday.